All right, we are actually live, Jason. Yay! Hello,
All
hello,
right.
everybody. This is Demetris Curry, and we are here for week 3, guys. We are here week 3 of the workshop with Ignite, and we're excited to be here on this particular topic today. If you have missed all of the previous information that we taught on, we're going to brief that real in just for a couple seconds before we get really started. But I want to take the opportunity to just say thank you guys for being a part of this amazing, amazing training for our small business owners across the state of Alabama. I am so excited that we have the opportunity to work with Ignite and the SBDC and the University of Alabama of bringing in some crucial information. And today I have a special guest, and we're going to get started on that as well. We have Jason Norton here with us with the PIMG. I'm so excited that you're here with us, Jason.
I'm excited as well, ma'am. Nice to see you.
Yes, good to see you. Good to see you. And we're going to talk in depth about commercial applications when we get to that, right? So let's jump right on in. I'm going to go ahead and start sharing my screen so we can talk about what we are getting ready to jump into, and that is securing commercial loans, right? Securing commercial loans. We want to make sure that we get right into the depths of how that's going to work. Want to say thank you to Ignite, Torrin Brazo, Executive Director, for pulling this all together, Over the last few weeks, and as you know, April has been our Doing Business in Alabama Minority Business Training, right? April 1st through the 29th, 11 a.m. every Thursday. For the first 2 weeks of this training, we first started off finding the information, getting the foundation down, which was term insurance versus permanent life insurance. What is that all about? Which one makes the best, product for what I need, right? So that's what we did. We focused on what that meant in our current lives and in our business, right? Because all of that is crucial to know what is best for us and if there's going to be a better product for us on the other end of the spectrum. So we looked at that, and then we also zoned in on key man insurance. Oh, Jason, you missed that one. Key man insurance on week 2, right? And which is one of my favorite things to do with the banking institutions, and to also help small business owners expand their business, right? But this week, we are talking about securing collateral-based commercial loans. Now, I could not do it without bringing on one of my favorite people, Jason, to talk about what we are doing in applications and what is the primary thing that you need, right, to get started in that. So what I'm going to do is first, let's talk about disclaimers. Let's make sure that everyone knows that we are live. We would do a Q&A at the end of this segment. And if we do that, I want to make sure that you are really, really careful about the information that you share. We do answer general information, general questions, but we don't want you to give too much of your personal details on a live segment. If you need a one-to-one with us, by all means, let's get that scheduled, right? Let's get that scheduled. So let's jump right in. Jason, I'm going to hand this off to you. I want to talk about what should I have ready for an application going right in to your organization, going to ask for a loan of a commercial loan. What is it that I need to have ready? What do I need to pull together, but even before I walk through the door?
Well, that's kind of a tough question sometimes, Demetris, because when it comes to individual lenders, they have their own needs list. But really, we've been able to see what they're all needing that's the same. And to be upfront, they're needing an address. They need to know what they're going to be lending against. Is it just raw land that we're going to be building a project on, a doctor's office, attorney's office, some type of multi-use building? Just needs to have an address. And then when it comes to FICO score, sometimes they'll take out the top and bottom. It doesn't have to be FICO score, but most of the time on commercial loans, they really want to stick with the FICO score, about 650 or higher. Then also they want to know experience. Now, if you happen to be someone who's experienced in the field, and let's say you're a doctor that's leaving an office and starting your own practice, They just want to know the experience plus the capital that you have, the liquidity that you have on hand. And that kind of leads into the next one. When it comes to that liquidity, they're really talking about, what you're going to be making over the next 12 months. And then also through tax returns, they can see what you've made in the past 24 months, and they can put everything together and get a baseline there, plus cash that you have in the bank. Then also any existing liens that you have on property. Let's say you've been in this commercial piece of property for a while, and you're just wanting to go ahead and purchase it because the owner has given you a good deal on it. Then we need to see a P&L, tax returns. There'd be some paperwork in there just to show what's called ATR. It's ability to repay. That's one acronym, especially on this side of lending. You have to remember it's the ability to repay. And then you go into taxes. Well, the taxes can be taken two different ways. It can be taken as tax returns for the past 24 months. Let's say 20s haven't been filed. I need to see an extension plus 18 and 19 that have been done. Or taxes are going to the county tax assessor's office and get me a tax card on that parcel and that address. Then you go into insurance. Well, our insurance is not like Miss Demetris insurance. She's handling that side of financial growth. So what we do is we take the financial growth here that we're building, but we still have to get more or less like a homeowner's insurance on your owner occupied property, except we're doing this on the commercial level for non-owner occupied. And then your population, sometimes in certain instances, the dot on the map requires a certain population. It's I equate it to USDA eligibility on the retail side. USDA put like Huntsville, Alabama, they draw a line around Huntsville. Anything outside of that is USDA eligible. Well, they do the same thing with population when it comes to loans. It gives a rural or city designation, and it also affects rate and then term. Then you have your rent amount and lengths. Length of lease, sorry. More or less what it is if you're in a situation right now to where you're paying $1,000 a month and the owner is in a situation to where he's only having to pay $600, you have a certain DSCR in that instance where you're wanting to be, in layman's terms, $1,000 a month total expenses, $1,500 in rent, that equals 1.5 DSCR. And then bankruptcies. They want to make sure that you have no bankruptcies or judgments in the past 24 months. There's certain lenders that'll make exemptions, but that's all on them. We can go and ask for an exemption, but it's up to them to clear it. And then everything has to be attached to real estate, an actual piece of property, and then of course, closing an LLC.
Wonderful, wonderful. So let me put a pin in it right there before we go further. So when you're talking about the liquidity on hand, is there a specific amount of liquidity that you're looking for in a small business? Let's just say that it is a new business owner, first time business owner. What type of liquidity are we talking about?
There are instances we have lenders, let's say on new construction. What they're wanting to do is they want to make sure that the purchaser is coming with 35% down to the purchase price, and then they'll do up to 100% construction, as long as you stay within the LTV range of 70 to 80%, whichever one they designate for that dot on the map in the project you're putting together. And right. once that's finished, that's usually the constructions, of course, are short term. They're usually 24, 36-month loans. Mm-hmm. And when you're done with the property and go ahead and move in, then that switched over into a 20 or 30-year amortization schedule, whichever fits your P&L. But gotcha. You're talking anywhere. Go ahead, Dawn. What'd you say?
I'm sorry. And when you say loan to value, you're talking about LTV. You're saying loan to value, just so yes, those. Ma'am.
Yes, ma'am. Okay. If your property appraises for $100,000 and the lender says we'll go to 75% count and closing, your loan max is $75,000.
Gotcha. Yeah. That makes a lot of sense. On the taxes itself, tell me about the taxes. And we're looking at about 24 months of taxes. And let's just say it's still 2020. Some people are still getting extensions on their particular taxes for 2021. Let's just say that they have not filed 2021 taxes just of yet. Can they give you the previous years of taxes? And if they can prove that they filed an extension?
Yes, ma'am. What happens is we go back, let's say this year they're filing 2020 taxes. We have not done that, but they filed an extension till October. Even though the
Right.
government's extended it, they go ahead and file an extension till October. Well, as long as I have that printed, IRS states that they filed an extension, they can, do their taxes in October, and then they've already filed their 19 and 18 taxes, we're
Mhm.
good. Because what they're going to
Wonderful.
do is add those 2 years and do a rolling 24.
Exactly, exactly. And that's important to know, because some people are like, oh my goodness, I haven't filed my taxes this year. I have to wait to put in the application. When really you
Mhm.
don't have to wait to put in the application, because you haven't officially filed your taxes for this year, but you do need to be able to prove that you've got an extension on that, right?
Mhm. Yes, ma'am.
Gotcha. I gotcha. Can you give us a little bit more details on the rent amount and the length of the lease? Give us a little bit more detail on that.
Well, it depends. I mean, there's certain situations where I'd rather pay 5.25% on a 15-year than 4.25% on a 30-year. And a lot
Mm,
of people don't understand how if the banks are controlling that interest rate, there's got to be something in it. So if you really do the math, you end up over the course of time saving yourself, in instances, I've seen 75 to 100, I've seen $200,000 in savings.
Oh
So,
yeah, oh yeah.
yeah.
You're talking about that amortization schedule and that compound interest. It's just
Yes,
is
ma'am.
it really makes a huge difference in how fast you pay off of a loan, and saving some of that interest that accumulates over a longer extended time.
Yes,
Absolutely.
ma'am. Yes,
Yes,
ma'am.
we're going to jump more into that, as we go on further, and we're going to ask some more questions in that. So stay with us, okay, Jason?
Yes, ma'am. Yes,
All
ma'am.
right. So, is in addition to that, everyone that's listening today, here are some of the other things that some of the requirements of preparation that may come up. We just talked about credit scores. We also talked about business plans, but you also may need a third party appraisal on that property as well, just to see, what that value is in that property. Proof of citizenship, and some types of programs require that you have some proof of citizenship. That is a possibility that you have that there. And then also looking at your books and your records. That was one of the things that we just talked about, your P&L statements, your cash flows. All of that is very crucial information to what you need when you first go into an application. So let's talk about what this segment is geared around. And this is about insurance as collateral to your property, right? So in the line of business of what I do, I work with business owners that are in the process of getting a business loan. And one of the requirements that the underwriter may place on their application is you need insurance on your life, not just on your property, but also on your life. And there is a collateral agreement or assignment that's attached to your life insurance, where the banking institution or the lender is going to hold that as collateral, right? Hold that as collateral. So collateral, we know what that is. We know it is an asset. We know that it can be property. We know it's something that can be liquidated in the event that something was to happen to a particular loan. That's what we're talking about today, how we can use that as one of your forms of collateral and getting that commercial loan, right? The business loans are really sort of pledged to that lender, okay? What you want to know about a commercial loan is this, is that when you're doing with a commercial loan, not only do you meet those requirements that Jason just talked about, but let's also keep in mind that, when you get ready to pay off this loan and you have that particular insurance, there are strategies that we're going to talk about at the end of this PowerPoint that you need to be putting into place, right? We talked about this the other day, Jason. We get too excited when we start talking about this
I
kind of
know.
stuff.
I know. Yeah.
And we were speaking about infinite banking. I know that's going to be something that we really zone in on in the last weeks of this training. But all of this is leaning in that direction, right? All of this is leaning in that direction. And one of the things I want to make sure we brought across today is that if you are a small business owner, or even if you have a franchise or a large business of some sort, right? When they look at the stability of your company and they look at what you have in assets and your FICA and, the property value and your loan to values and all of these things that they're going to look at, your ability to pay, all of that, even with that, if you don't have all the assets that they feel that you should have to make it a secured loan, what do? They lean on what they call a commercial loan insurance policy to help you have even more security of the lender, to feel more confident that they can give you this monies in the event something was to happen, their loan is paid in full. So that's what we're talking about today, is that reducing of the risk of losing money as a lender is what they do with these type of insurance policies. Okay. All right. So we can also talk about cash secured loans, right? So if you have enough cash on hand, a lot of times they can use your cash as securing of a loan. Have you ever seen that before, Jason, where they can just use your cash that you already have in the bank, right?
Yeah,
They
it's
have it
called
in the
leverage.
bank. It's
Yeah.
leverage. It is absolute leverage. And they can say, hey, you know what? This is what we can do. You have about, I don't know, 50,000 in the bank. You have 100,000 in the bank right now. Let's lose that part of that and put a lien against a certain portion of that, right? And then that way you can't really use those funds until the loan is actually paid in full, right? So that is also another avenue that is used for this. We already know that real estate is the main thing that's important for getting a commercial loan secured. Would it be, the equipment, the fixtures, the inventory, vehicles? If you have a business, let's say you're a plumbing business, well, you have all these vehicles from your plumbers, right? All of that is part of your commercial properties that's included in here, right? So those are some of the things that you can use as tangible hard assets against your business, things that they can put liens on. The lender can actually put liens on as collateral to help you with your commercial loan, right? To help you with your commercial loan. So you also have what we call the invoice collateral. Another class of collateral is based off of your future earnings, right? So we talked about this real quick, and Jason, let's tune in on this just a little bit, because we were talking about your receivables and your ability to pay, right? We were talking about that a little bit earlier, and so with that being said, your receivables, your income, your everything that they know that you have a fixed amount of income on that is going to be there, they can look at that as streams of your ability to pay, right? Some of the other business loans require that you have, home and car, additional assets and so forth. But there are some things that we can do working with the SBA, right? That may require some things. And I think that your organization also have that, right? They do have the
SBA loans. We have lenders that
we
will do
can
that.
do that. Exactly. Tell us something about that, because that is one of the major questions that I get on a day-to-day basis with working with some of the small business owners. They want to know, hey, how can I get in on that SBA part loan for a commercial loan? Tell me about what your organization is doing to help them reap the benefits of that type of loan.
Well, what we're helping them do is make closing times quicker, because we've already done this type of loan before. We're looking at, we already know what the paperwork is, the needs lists that come at us. I try to make sure that everything that's needed to close the loan is gotten up front, and our team is trained to do that. Because if you can put the lender in a situation where they're seeing everything they need so they can go ahead and order title and appraisal, then we're good. Now, right now, I want folks to understand, and this is all across the country, everywhere we have a branch manager and everywhere we're getting loans from. Title work's taking a minute, and also appraisal times are taking a minute as well. So when you're dealing on third parties, that might stretch its legs a little bit. But when it comes to SBA loans, as long as you're making sure you get everything that the underwriter's asking for one time, you're pretty golden. I mean, you're heading in a positive direction, and that's the way our team's trained.
That's wonderful. That's wonderful. And see, that's why I got you on here with us today, because you're already doing this every single day.
Yeah.
And that's why I got you on with us today. So this is amazing that, we have the opportunity to look at that. So we were talking about insurance, and we were talking about how you can use insurance as collateral. So we're going to jump a little bit further into how that works, right? So most times when you're looking at life insurance as an acceptable collateral assignment, right? Even though you can list some carriers, it really depends on the lender. Some lenders require that that particular policy is a permanent policy. Others are okay with a term policy. Most of the lenders that we work with request a permanent life policy, right? Which has cash flows involved in it, okay? And the reason why that is, and this is what I've seen just recently, is that if you were to default on your commercial loan and you've had it for a while and has built some cash flows into it, did you know that the banking institution or the lender who has access to this particular policy will also have access to the cash in that policy and to help with those past due premiums that you got behind on? Did you know that? Oh, yes. Jason, did you know that? I know you did. I'm just messing with you. So, so I mean, exactly. I mean, can you believe that that is one of the features, right? That the insurance, having insurance tied to your policy gives the lender much more security. It knocks off a lot of the risk, right? That they were going to take by giving you a first-time business owner loan, right? Or even someone that's expanding their business and maybe opening another location, right? If you are trying to open up another location and then you're trying to work out all the details of your cash flows, this also gives them added security, right? Added security on that. So in the event that you were to pass and you are the person that's paying for this particular insurance and you're paying for the loan, you are the applicant, right? What happens is that they have had a number of information submitted to the life insurance company, and the lender, the banking institution, they will actually send a collateral assignment agreement to the insurance company once they agree to use your insurance as collateral, okay? And when they do that, if you were to pass during that time frame of your loan, let's say that your loan is a 10-year loan or 15-year loan or a 20-year loan, right? If you were to pass in that time frame and the loan was never paid in full, you still have collateral of your life insurance tied to that loan. That means when you pass, that loan is paid in full by the policy itself, okay? And so that is also something that you have to keep in mind, that you also have that as a backup plan. If you were not able to pay off that particular loan and you were to pass, that loan is paid in full. So it keeps it from, passing that debt on to the next person and passing on to your business partners and things of that nature, right? Because you want to make sure that it is covered. You want to make sure that it is covered. Now, how about startups? If you are a startup, right, the basic requirements of lending institutions are met. Typically, when you are a startup company, if you are getting for, say, let's say a $500,000 commercial loan, right? Then what they want to do is they want to make sure at least 90 to 100% of that loan value is covered with a life insurance policy that matches the face amount. So you would need at least $500,000 in face amount to be exact as the face amount of your loan. Does that make sense? Right? Because they want to make sure the entire loan is paid in full. Absolutely. They want to make sure that they're not losing out on paying off this commercial loan, right? And it's crucial information to keep that in mind. But what I love about this policy is that there's more to it in the end. And we're going to talk about that in the end. Will I need collateral if established and expanding? Absolutely. Absolutely. There's no question in that. You will need some type of collateral. Isn't that right, Jason? You will need some type of collateral regardless of whether you're expanding or if you are a new business, right? Because the lenders want to make sure that they are not at high risk of losing out on this particular monies that they're giving to you. They want to make sure you can pay it back, right? The loan officer then reviews what the underwriter has required, and they get in contact with that borrower and they give you a list. They give you a list of what you would need to bring with you or what you need to start working on providing. For instance, if you don't have your P&Ls in line, they're going to tell you they need a P&L statement, right? If you don't have all of your tax statements, they're going to say, hey, okay, we got the first year tax. I need you to go back and get those second and third year tax, right? If that's what they require, right? An established business, they may even look at how much assets that you have received over the years, right, from that particular business. And then if that's enough, they may just use your assets and your assets alone, and you may not need a life insurance policy as a secondary collateral, right? But in some cases, if you don't have it all, then they use that as a secondary collateral option. Does that make sense to you guys? So let's talk about the recording of collateral structure. They're going to be very consistent. I've seen dozens and dozens of collateral assignment agreements. Because I write through so many different companies as a broker, I can tell you that a lot of them have some different verbiage in them. However, what is always consistent is the main contract, the promise statement to pay, what you're going to have in that contract, what they are requiring on a promissory note. All of those three things or four things are going to be required in all aspects, right? All aspects of your agreement with them, okay? And how does this affect you as a business owner, okay? So let's lay down the ground rules. The ground rule is this. You as the applicant will be paying the premium on this policy. Now, what does that mean? Not only did you get the loan itself and you are responsible on the promissory note of that commercial loan, but you're also required to make the payments on that life insurance policy premium, okay? Why is that? Because you are the person getting the loan and they're just gonna hold it as collateral to help you meet the requirements of the lender, okay? The collateral assignment is a legal document of collateral between the insurance company and the lender on behalf of the insured recorded with the state, okay? So what that means is that there is a legal documentation that comes from the banking institution or the lender to the insurance company in your behalf. And when they do that, they say, hey, I know that you have a loan. As the insurance company, we will secure this loan with this collateral agreement. We're signing off on it. The institution sign off on it. And the person getting the application are all three signing off on this one documentation. It is then recorded, okay? And when they do that, they say, okay, once this loan is paid in full, we will submit to the insurance company what they call a release of collateral assignment. Okay, that release of collateral assignment sent to the financial institution, they check it off, sign off on it. Whoever is their authorized person to sign it, may be the president, it may be the legal document, whoever is required to sign that at that institution, they will actually sign off on it, send it back to the insurance company. And guess what? That policy that the business owner has been paying for, okay, is now completely theirs. Oh, I get so excited when I hear that kind of stuff. Yes, I do. Because the cash value that has built into that policy that you've been paying for all this time is there. Jason, you already know where I'm going with this. You know?
Yeah. Yes, ma'am.
Because we talked about this the other day. It was like, oh my God, we get so super excited, get goosebumps, right? Because the cash value that you've actually been putting into that policy is not null and void. You can still use that now in the future for something else. And we're going to talk about that as well, okay? But the key thing is, once you get out of that commercial loan, right? Once you get out of that commercial loan, everything that you've built up into that policy, that permanent policy, now you have access to do other things with, and we're going to talk about that. So what happens when the loan is paid in full? Is it celebration time, Jason?
No, ma'am.
What time is it?
It's celebration time, but it's time to reinvest.
It's time to strategize and reinvest, right?
Yes, ma'am.
In your own business. It's time to strategize into your own business, invest in your own business, and things like what? Possibly expansions, inventory, right? Possibly bringing on another business partner if that's what you're looking at doing, right? So those are some of the things that we're talking about. We're going to be discussing cash flows right now. We're going to jump into cash flows. And we talked about this last week. And as I switch this screen and move on to another screen, I want to make sure that, you know, what we talked about last week, I'm going to zone in on that just a little bit. And can you see these numbers right here, Jason? Can you see those numbers?
Yes, ma'am.
Absolutely. Wonderful. See, last week when we talked about key man policies, right, we talked about what it looked like to be the person in your business that is the primary person, that if something was to happen to you, how to make sure that that particular policy pays off, you know, everything that needs to be paid off. And then the person's left behind is the one able to use those cash, like partnerships, you know, or maybe board members that may were to pass, that kind of thing. If they were to pass and they were crucial people in your business, and if they were to pass, what happens when I lose that crucial person in my business? How do I secure my business? So we talked about that last week on key person policies. This is a different illustration of someone that has a commercial policy. Now, these can be customized in any shape or form based off of how the lender requires that it looks, okay? Really the death benefit amount. So I looked at this one and I just came up with a sample. I went ahead and blacked out the carrier's name because this is for educational purposes only, not trying to actually sell a particular product. We just want to make sure we can illustrate what this looks like, okay? All right, so let's say that this John Doe is getting a $775,000 commercial loan, right? And the institution has said, hey, you need to have a death benefit there. And he says, okay, I'm going to get a permanent policy, but I want to overfund this policy as well. So because I know I can use it later once I get rid of this 10-year or 15-year commercial loan, right? So what he's doing is he's putting in $1,000 a month into this policy. Now, keep in mind, that's just what he decided to do. He doesn't have to put that much into it, but $1,000 a month into this policy, we're looking at $12,000 an annual premium per year. Now, at an estimated rate of 6.45% non-guaranteed assumed rate. And the reason why we're using that particular rate is because this particular company here that we're looking at has an average of rate of 6.45% over the last 25 years of interest rates, right? So they take the average and they guarantee you what you have there. So what we're looking at is what we know it could be for the current year, 2021. Now, $775,000 is the death benefit of this policy. However, because he's overfunding the policy, during the time that he's also paying for his commercial loan with the lender, he's building account value here, okay? Can you see that cash value there? He's building that cash value there, right? And let's just say that he has a 15-year loan. What's the typical commercial loan amount for you guys, Jason? Is it 15, 20 years, 10 years? What's the typical?
Actually, I noticed right now, we're getting a lot of folks out of a 15 or 20 because they're wanting to go to a 30.
Okay. So let's just say that if we did 15, 20 years, and we'll also look at 30 years, okay? We'll see what that value would be in that time frame, right? So let's just say in 15 years, and I'm glad I asked you that question because I know that as the industry changes and economic, conditions change, then the amount of years that people are asking for as far as paying back also varies, right? So 15 years, let's just say, if John Doe was to pay off this commercial loan in 15 years, and he has been putting money into this collateralized insurance policy that what the lender required that he have, right? The lender required that he had this policy to help secure his commercial loan for his brand new building, for his let's say a veterinarian shop, you know, or possibly his law firm, or even if he was opening up a retail shop, right? Whatever the type of company it was, right? They said you must have a life insurance policy equivalent to the amount that we're going to lend you, which was $775,000. So he is now to a point where he is paid off that loan. What happens to that loan? Well, we just talked about it. The commercial loan company sends in what? That release of assignment, right, Jason? They send in that release of assignment to the insurance company saying, hey, now that this is paid in full, we're releasing our lien against his life insurance policy. He is free to do whatever with it that he wants to do with it, keep it, cancel it, whatever the situation is, okay? But John Doe had other plans. He said, no, I want to keep it because all the money that I've put into it up to this point, I now have access to, right? That's strategy. That's what you call strategy, right? So in this strategy, 15 years, he has $783 in this particular policy at that 15-year mark. To do what with? To do whatever he needs to do with. Maybe let's say that he needs more inventory for his business. Let's say that he needs to bring on some more staff for his business, right? Because he wants to expand. But like Jason just said, we're getting more and more people asking for what, 20-year and 30-year, Jason? Is that what you're saying?
Yes, ma'am.
Okay, so let's just say in 20 years, $204,000 there, right? And then also in 30 years, $377,000, almost $378,000 in cash that he has access to. Now, what I like about a policy of this sort, right? You can actually see how much he's putting into the policy versus what he's getting out of the policy. So let's just look at this area here. If we look at year 20, let's look at year 20. Notice that in year 20, it tells you how much he's paid over the years into this policy. So you're looking at $240,000 over a period of 20 years, right? Now, what he has in cash at that point is $204,000. Keep in mind, he also has the death benefit, right? So a portion of that you can see has gone to cash. The other portion has gone to death benefit, but at some point he's going to exceed what he's actually put into the policy and what he's getting out of the policy, right? So look here, let's say at year 25, what do we have? We have $290,000 in cash in this particular policy, right? Now, you're looking at how much he's put into the policy at $360,000 here, getting out $377,000 there. You're looking at the equivalency of what is going on in this particular value. Keep in mind, when you're ready to take this monies off of the policy, it is loaned against the policy. We put a lien against your policy. When you are the owner of a policy of this sort, you are able to call the insurance company and say, hey, I have $200,000 in this policy. I have $300,000 in this policy. I want you to send that to me. You're not applying for it. You're not asking if you can get approved for it. It is already yours. You're just telling them that you're going to put a lien against your insurance policy, and they're going to send that to you, what? Tax free. Mm-hmm. That is strategy.
Yeah.
That is strategy, Jason, right? And you and I were talking about this the other day. So I was just like, oh yeah, this is going to be magic. This is going to be magical when we talk about this, right?
Yes,
how are you liking this concept? Because I know you have your own thoughts on this concept.
Yeah, the concept's great, especially with it being tax-free, because all you're doing is you're moving money from one industry to the other. I mean, with the cash value you're getting from there, you can put over into the property itself. And at that point, just expand the company or expand your portfolio.
Exactly. Buy more properties, right? Mm-hmm. Yeah. Buy more properties. So let's say that you are a person that's into real estate that want to buy more investment properties and more investment properties, right? Or do a flip, If you're a person that like to flip properties, this would be
well, it may be a situation where, like an attorney, he's in the building that he's in. Well, there's enough cash flow there or enough equity built up. We can change the liquidity there and use it to buy another property to where he can bring on 4 or 5 other attorneys, create more cash flow that way, and also start this type of policy, not only to build up wealth, but just to have the cash later down the road.
Isn't that amazing? Isn't that amazing?
Yes, ma'am. Yes,
It
ma'am.
is. And it's all about, really, it's about the strategy of it all. And so, what we find, as business owners and as small business owners, a lot of times we just don't know that we have that capability to be able to do something like this, because we didn't really know down the road that we can maximize what we've already put into place, right?
Yeah.
Maximize what we put into place, and how that would affect us, what we can and could not do from it, right? So it's amazing to see that. I am going to also pull up some more information here. And I see that we have a question that just came in, wanting to ask, what do we do if we are behind on paying taxes, but we are in the midst of paying taxes back?
As long as you have an agreement, whether they're state taxes or federal, as long as an agreement's in play, that can be added in when they're doing their scenario.
Wonderful, wonderful. So that is something that definitely can be addressed if that was to be going on at that time, right? So let me look and see what other questions that we have out here that are coming in. What is the name of the type of insurance policy? Again, that is a permanent policy. We can actually do a policy of this sort with anything like a whole life policy or possibly an index universal life. So really depends on the situation itself, what's going to be better for you. But this is a permanent type policy that we're looking at, Ms. Patrick. Thank you for that question. She said, I didn't know that. It's good to know that, that people are getting some really good content out of this, that they're finding this to be really, really helpful, really helpful. And I want to go in with you a little bit more. You're welcome. You're welcome. I really want to go in as well on your flips that you do with properties, Jason, because I know as an investment properties, and you also work with individuals that are buying investment properties all over the world, not just in local Alabama. They may want to buy investment properties in other countries. Tell us more about how that works in an application process.
Let's say somebody's wanting to purchase a property in Kansas City, Missouri, and they're wanting to do a flip. I look at the situation here. Would you rather, if you have $100,000 in the bank and you know the price is this number, or let's say 200,000 in the bank, because a lot of people right now are doing flips for larger amounts. And you can buy a house for a certain amount, and you know that you're going to have all your own money and leveraged into this, counting the purchase and your scope of work for your schedule to make sure that you meet a certain day. Well, if you go to a lender and you leverage your money, you're going to have a situation to where, well, I'm bringing 25% down of this project or this property, the purchase price, and maybe some upfront fees that the lender's asking for. And at that point right there, I can do, with the same amount of money, I can do 2 or 3 different projects and triple my profit. Because if you're leveraging the smaller amount, you're still making the same amount of profit because you were going to have to spend the money anyways. Why not just let the lender spend the money?
That's a valid point. That's a really valid point. And that's another thing we're talking about, strategy. But you have to have sort of like people around you to help with that, get someone that can assist you with the inner workings of creating a plan of action, right? Of how to make sure that you're maximizing the opportunity that is coming before you. The business owners that I write these policies for, I tell them at closing, listen, when this is paid in full, I want to make sure that you call me before you pay it in full, right? Call me before you pay it in full, because I want to make sure that you get that release of lien on this particular policy, and then let me check your cash balance on this policy, and let me let you know how much you have access to you that you can use for whatever else you need to use it for. Because a lot of times they're just thinking, oh, I just have a policy to lean against this, and once it's over, I need to drop that and drop this. Well, quite honestly, you'll be giving up all of the leverage that you have created in your business to be able to buy more equipment and expand, to purchase new additional properties, using monies off that you've already built up over the years that you had to build up, that you didn't have a choice in building up, right? You didn't have a choice because it was part of your underwriting requirements to get the loan. So now that you have that built up, now use it as leverage, right?
Yes,
Absolutely. This lots of great information, Jason. Lots of great information. Oh my goodness. Oh, go ahead.
Go ahead. What's the question?
I was going to say we have another question, but go ahead with what you're going to say first.
Well, I was going to ask a question for you. When it comes to, let's say they're in a situation to where they paid off the loan early, because we know a little bit of a trick how to strengthen, because most of the commercial loans there has a daily per diem. So we know how to pay those off early, and we tell these to our clients. So if they're in a situation where they pay it off early and they have cash flow or cash still in the policy and also a death benefit, can that combination be added together and create, a larger number to draw from?
Actually, when you have a death benefit and you have a cash value, those are two different columns, right? Depend on how it was customized from the beginning, right? So in some types of these permanent policies, the cash flows merge into the death benefit, where in the end, if you decide to take something off of the cash flows, it also reduces the death benefit, right? So it depends on how it's customized from day one, right? What I typically do is I look at option A and option B before we actually do it to see which is going to be better for them in the end as far as cash is concerned. And then it tells me which option to go with for that particular client. So when you do a life insurance policy, they take into account your health. They take into account whether you're a tobacco user and your age, right? So with those three factors being put in there, it actually gives us a listing of what's really, really important on how much cash they can give in the end, or if it's going to be a rated policy. If it's going to be a rated policy due to health issues, then your cash amount very well may not be as high as it could be if you were in very good health. Does that make sense? So because the cost of your insurance is going to cost more out of your premium. That's what that means, right? Okay. So just really depends on the circumstances at hand. But one thing that we always do is make sure that we avoid what we call MEC limits. And I say, quote unquote, MEC limits, which is modified endowment contracts. That tells us how much an applicant can put into a life insurance policy without going over the requirements of what the IRS says you can put into it without it being a taxable event when you pull it out, okay? Yeah. So we try to make sure that always, and I always customize mine that way, so that in the event that they want to pull monies out 10, 15, 20, 30 years from now, like you just indicated, that the MEC limit was already taken into account for the IRS at that time. Yeah, so that's
tax-free money is always good.
Huh?
Tax-free money is always good.
It's always a wonderful thing. That's a wonderful thing. Love it. Okay, so we just had a comment. She said a lot of great information. Thank you so much. Thank you so much. I'm glad you guys are enjoying that. She said, I didn't get a chance to finish watching it all, but I'm definitely going to rewatch this. Oh, that is wonderful. Wonderful. Thank you so much for being here with us today too, Jason. I want to make sure that because you came on as a good friend of mine, I just really love that you just dropped everything and jumped on with me. So I really appreciate you. How do we reach you in the event that you have someone that wants to apply for a commercial loan here in the state of Alabama or abroad, and they say, hey, I heard him talking to Ms. D on the line with Ignite and SBDC, and it was very educational, and I want to have a one-to-one with him. What do we do about that? I know that we're going to also provide them with a link for them to make arrangements with me to be able to work with me if they need to work with me as well. And if I get some additional requests, I'll make sure that we have that for you as well. But here's the link just in case for anyone that wants to book with me and need to do a one-to-one for a 30-minute segment to ask questions about securing a loan with their commercial loan, need some insurance on how to do that, then this is the link here, a Calendly link, and my phone number, my 800 number to reach me. But Jason, how do they reach you directly if we need to get some applications in?
The easiest way to reach us would be to go to P as in Paul, I as in Igloo, mortgages plural, pimortgages.com. And you can go ahead and go through there. You'll see everything about the company. You'll happen to see our lending proposal. And if you just go through the steps on the website, there'll be some information. Leave what you're looking to do. I'll make sure that that gets to the proper person on our team. And we go ahead and really see what you're looking to do now. And then, of course, see if there's any experience that can make things just make the loan process quicker. And at that point, what do you need to do? You know, what's your dot on the map? We put a fence around that and we go at that. We go exactly for what you're needing.
So if I want to buy a property in Australia, I can call you.
Well, I'll have to call them just to confirm it. But there's actually right now we have one lender that will allow us to do 10 countries outside the United States. So
wonderful, wonderful. Yeah, put a pin on that. We got to talk about that a little bit later.
Dominican Republic. I want to be on the. I want some property.
We'll talk more about that too, because we have some things in store. We have some things in store. But thank you so much for being on with us today. It has been an amazing information that we were pulling together today. I'm still getting people sending messages. I'm looking at the Instagram, and I'm also looking at this at the same time. So I'm getting more and more people asking questions and giving great comments of how informative this segment has been. So I am very appreciative that we had the opportunity to work with you, Jason, today on this.
Thank
and then
you.
also invite you on to tell us about what your company is doing to really help the masses of understanding how to maximize what they have in front of them, things that they generally don't get when they just walk into an institution on their own and don't know to sit down with someone and tell them what their dreams are and what their hopes are in expanding their businesses and starting a new startup business, right? So I'm excited. So next week, I don't know what you're doing next week, but I hope you get on with us. Because next week, we're going to be talking about how to put insurance inside of your business for your employees benefits. So we're going to talk about employee benefits, how that can actually help you as an employer in your taxes as well, offering pre-taxed benefits, things like, oh no, we got critical policies, we got hospital plans, accident coverages, even the whole concept of adding in things like short-term disability and life insurance. Those things are post-tax items, but you can also bring those things to the table for your employees. So they'll have that at deeply discounted rates. And in addition to that, it helps you as an employer to be able to offer that to your staff and stand out from the competition. You got benefits over here and they don't have benefits over there. I'm working with you. I mean, you would not believe benefits, being able to offer benefits as a business. It is a complete game changer for businesses that don't have benefits, and they end up losing sometimes some of their best employees ever because they just had to go where the benefits were, right? So we're going to talk about that. And then at the last week, Jason, I'm going to jump in on one of your favorite topics, infinite banking.
Yes. Oh, I love it. It's just it's a wheel that only grows. It only grows. It does not get any smaller. It only gets bigger. And it's crazy when you're paying cash for everything. You become your own bank. That's the best part.
I know it. So we're going to talk about that as well. I know you get passionate about that thing. I have to put up and say, stop, Jason, stop.
Yeah. Oh, yeah. Yes. It's generational.
It's generational. Yeah. We're going to talk about that in the very last week of April. And so I'm ecstatic. Thank you so much. And for everyone that had a chance to join us on this segment, thank you for joining us and giving us your insight and your questions. We really appreciate it. Make sure that you go back and look at week 1 and week 2 on Ignite's Facebook page if you missed it, and then replay this segment as well about how to use collateral into your commercial loan, okay? Talk to you guys later. Thank you so much, Jason.
Yep. Have a great day. Enjoy.
You too. All right. Okay, bye-bye.
Bye-bye.